So, no surprise, central banks tighten monetary policy. And the way they tighten monetary policy is by either raising interest rates or lowering the purchases of the financial assets that they buy by expanding the balance sheet. So that's where we are in that cycle. Now, if you look at how markets behave in that part of the cycle, this is breaking the cycles into three parts: the early phases of the cycle, the mid phase of the cycle, and the late phase of the cycle. And this is across the world, different countries. This is the United States, this is Europe, to show how the historical. So we're in a period of time, this period of time, which is relatively late in the cycle, is also associated with a period of time where there is less attractive returns, greater vulnerability. So that's largely where we are in the cycle. Interest rates have hit their lows, in some cases can't go lower, and then we're dealing with the issue of quantitative easing. So taking this back to, this goes back to 1900, this shows debt to GDP ratio in the United States, and it just shows how the cycle that we're going through now is very similar to the cycle that we went into the 30s. In other words, because of that debt crisis and interest rates hitting zero, you had the printing of money. This shows the central bank's balance sheet, the monetary base, the acceleration of printing of money. Same thing happened in the 2008 financial crisis. You could see that what happens is you have the debt crisis, you have the hitting of zero in interest rates, they're stuck, so they have to print the money, and then we have the reaction.